Sub-Saharan Africa is feeling the heat as the global economy takes several punches. And growth in the region will slow this year to 3.7%. From there, we look at South Africa's economic outlook as consumers feel the pinch with rising inflation. This is Business Edge. I'm Tolulope Adeleru-Balogun. Let's start with the African business headlines. We start in southern Africa, where South Africans woke up to news that governments will slash the pump price of fuel from the middle of next week, aiming to ease the burden on consumers of soaring energy prices since the Ukraine war, which has pushed inflation above the upper limit of the central bank's target band. The energy minister announced the measures overnight, which include a drop in the price of gasoline by 1.32 rand per liter from Wednesday. The 36 billion Kenyan shillings or $305.5 million loan to national carrier Kenya Airways in the current financial year is conditional and will be released in installments on achieving set targets. Kenya Transport Principal Secretary Joseph Njoroge said that the airline has been given targets and the money will only be released when the airline achieves those targets. The targets, which have been set by the government, are assessed by Seabury, an advisory firm overseeing the restructuring of KQ, which is known by its international code. The Central Bank of Zimbabwe has raised its benchmark rates from 80% to a fresh record of 200%. This increase comes as Russia's invasion of Ukraine drives global commodity prices higher, exacerbating inflation in many countries around the world, including Zimbabwe. Finance Minister Mthuli Ncube believes that aggressive tightening of monetary policy is necessary to counter these inflationary pressures. Like many other countries, Zimbabwe is facing a rise in the price of imported food, fuel, fertilizer, and other essential commodities. And according to global consulting firm Mercer, 22% of organizations in Egypt have addressed employee compensation by either providing increased salaries or temporary allowances in response to the country's recent currency devaluation. Mercer's 2022 Egypt currency devaluation spot survey demonstrates that some countries and companies are seeking to rapidly address compensation for employees in Egypt, with 15% of companies indicating that they plan to raise employee compensation. However, 46% of organizations report that they are planning to take action but have not decided anything specific just yet. And those are a few business headlines to get us started. After the break, let's look at the US dollar rising to historic highs as global inflation soars. The World Bank predicts that growth in Sub-Saharan Africa will decelerate to 3.7% this year in its Global Economic Prospects report. The Russian invasion of Ukraine, the resurgence of COVID-19 in China, and the current hawkish policies of the U.S. Treasury to battle rising prices brought on by inflationary headwinds have all contributed to price pressures. As governments increase expenditure on subsidies, assistance to farmers, and in some countries, security, fiscal headroom is becoming even more constrained. However, the effects of the war will differ from African country to country because rising commodity prices may help lessen the negative effects of excessive inflation in some major exporters of commodities. Add to this that the US dollar, the currency that powers global trade, is on a tear that has few parallels in modern history. Joining me from Lagos, Nigeria is Dr. Andrew Nevin. He's the chief economist and partner at PwC Nigeria. Andrew, welcome to Business Edge again. It's so good to see you.
It's always great to be on Business Edge. Thank you.
So let's look at the growth prospects for the Sub-Saharan Africa region, and that's meant to move down from 4.2% to a 3.7% for this year. High inflation, policy tightening again, weakened domestic demand. Is there really anything that the continent, maybe as a whole, could have done, or individually now when we look at the economies, to sort of lessen the impacts that we're feeling now?
Well, I mean, the reality is we're always buffeted by these global forces, and we can't necessarily do anything about the global forces, but Africa can do something about what happens in Africa. And I think what's the most promising is AFCFTA, I mean, it's obviously just right at the beginning of it, but I mean, we've said for a long time, Africa can only be prosperous if Africans trade high value goods and services with Africans. And so we need to focus on making AFCFTA work. I mean, here in Nigeria, Francis, the AFCFTA secretary, it's a brilliant young Nigerian who's driving this process along with the federal government. And I think if African countries stick to the step-by-step process, we can counteract it. But in the short term, I mean, you just have to deal with the cards that you're dealt with, right? I mean, we've had all the crises that you mentioned. The Russian invasion of Ukraine is particularly severe. The big impact is having fertilizer prices driven up around the world, food prices driven up, which is really has a huge knock-on effect here. Of course, the thing that's very sad in our situation in Nigeria is that we're supposed to be an oil exporter. So we were lamenting, if people might remember at the beginning of COVID, oil price dropped briefly below zero. We were lamenting at that time how difficult it was for Nigeria as an oil exporter. And here we have over $100 oil for a number of months, and we yet been noticing to be benefiting for the reasons people understand the foil subsidy. And the reduction in production because of crude theft, because of pipeline vandalism. So we should be in better shape in Nigeria. Unfortunately, we're not at that point.
So when you look at all these indices, high inflation, global supply chain disruption, and more, are you on the side of many of those who believe that we're on the cusp of another global recession?
I think we're in a recession. I mean, if you look at the numbers, I mean, it's up to the National Bureau of Economic Research based in Cambridge, Massachusetts, to declare a recession for the United States. But we've now had 2 quarters of shrinkages in the United States. Europe came out this morning with very weak PMI numbers, Purchasing Manager Index numbers, negative for the big countries, I think, France, Germany, Netherlands. So, I mean, I think we're heading into recession, but or are in it. I think the other, certainly for the developed countries, whether we are globally, we've never really been in a global recession because we've always been counteracted by China and more recently India, and the emerging markets grow even if the developed markets are shrinking. But I think the thing that, if you ask what I'm most concerned about in the kind of medium term for the global economy, in fact, it's what's going on in China, and not just the disruption due to COVID because of their zero COVID policy and the impact on supply chains and manufacturing. But people who follow this closely know there's a massive housing bubble that's deflating in China and real problems with indebtedness. Evergrande is the kind of number one, $300 billion of indebtedness. But Chinese residential real estate is the largest asset class on the planet, and it represents at least 25% of China's GDP. And the reality is China's population is shrinking. Its working age population has been shrinking for a number of years. So if your population is shrinking, how do you build so many units? So that, I think, has the potential to really take us into a difficult space in the next 6 to 18 months. And I think you're really getting focus on the Chinese authorities and how to prevent it, because of course they're not worried just about recession. They're worried about social unrest. Chinese people save money by investing in residential real estate. So if residential real estate is now going down in price significantly, or they can't sell it to someone else, another investor, there's going to be really social unrest in China. So that's added to the mix of the challenges the globe faces.
So let's go back to the commodity situation that you mentioned. Sub-Saharan Africa's 3 largest economies, Nigeria, South Africa, Angola, should be enjoying a bit more because of these high commodity prices. But we know that's not exactly the situation. You've made mention, of course, a bit of Nigeria, but let's look at it in terms of these 3. Why are they not enjoying these high prices right now?
Well, I think to some extent, I don't want to say South Africa's economy has done well, but they've certainly done well on kind of a balance of payments side with the higher commodity prices. So they haven't had the exchange rate pressure that we have had here. What we've seen under the Naira, the Rand has held up relatively well. But I mean, they really have structural issues around their economy. I mean, we are, I think, 26 years post-apartheid era, and I think we all would have, and I was born in South Africa, just full disclosure, we all would have thought South Africa would be further ahead at this point, but they continue to have, I mean, we think we have unequal distribution of income in Nigeria, we do, but in fact, statistically, it's often reported that South Africa is the highest income inequality in the world, and it's really a problem. I mean, we need everyone in every society, but in South Africa, particularly at the moment, to be included in their economic growth. So it doesn't, at one level, I mean, anemic growth hurts everyone, but it particularly hurts the bottom of the pyramid in South Africa. And so many people really are not participating in fruitfully in the economy there. So that issue, South Africa is not solved. That's their primary issue. Angola is a bit of a different situation. They produce lots of oil. They don't really have any exchange rate problems at $100 oil, but they have not structured their society for this wealth to trickle down to be shared again across the whole society. So the oil wealth is concentrated in a few families. We know some of the names that have been in the news, and the link between business and politics in Angola. So Angola has a long way to go to be able to share that oil wealth like a country like, say, Norway or Canada shares it.
All right, so when we look at this situation that's happening now around the world, we're seeing tightening of monetary policy in order to combat the rising inflation. We've seen that happen in Ghana, Namibia, Nigeria, Rwanda, Sierra Leone, and even South Africa as well. Rising core inflation in countries like Cameroon, Nigeria again, and Uganda also points to broadening price pressures. While there's really no short-term answer, because you mentioned again in the beginning, short-term is so very difficult for anybody to manage right now, is there any policy direction or any policy action that you think African countries can take now to start lessening the impact of these global headwinds that our economies and our citizens are feeling?
Well, I don't know about all of Africa, but we certainly have a view on Nigeria. And of course, in the Nigerian context, we all understand there are many things we have to import. We have to import computers. We have to import equipment for generating electricity. We currently have to import solar panels. We have to import mobile phones. So we have a high demand for imports, and that's not going to go away. None of those things we're going to produce quickly ourselves on that. So what can we export in the short term that's going to earn foreign exchange? Now, we've just seen we should be sitting here at $100 oil, 2.2 million barrels a day, and we wouldn't have an FX problem. Unfortunately, we're not producing 2.2 million barrels a day. We're producing 1.1 million. And of course, most of what we're earning, we're then spending on the foil subsidy, which is by far the largest in the world. I mean, earlier in the show, you said South Africa's cutting foil prices. What they meant was they were cutting the taxes on foil, which reduces the price at the pump. We have no taxes. Of course, we have this massive subsidy. But what can we do? What we should be exporting are high value added services where Nigerians can insert themselves into global value chains. And this is an immense market, and people are starting to recognize how good Nigeria is at it. So I'll cite, people who've heard me speak know I always cite the amazing heroine Amal Hassan, who started the company Outsource Global. This has over 1,000 employees in Kaduna and Abuja who serve US and UK companies earning foreign exchange for Nigeria without people leaving the country. And it's much easier to create a job in this outsourcing industry. It's faster and it's less capital intensive. I think to produce one job at the Dangote refinery is about $300,000 of capital investment. To produce one job in the outsourcing industry is about 10 to 15,000. And we have brilliant young people in Nigeria. And of course, the number of people, if you just take programming, there's about 28 million programmers in the world. That number is going up to 45 million. We're putting out a paper soon that said over the next decade, that we should be aiming in Nigeria to have 2 million programmers working remotely in Nigeria, exporting Nigerian brains, but without having to leave to be part of the diaspora. And really, that's the only economic strategy we can see that can solve our balance of payments problems and fix the economy. And that has implications for what we do about broadband. It has implications for what we do about power, but particularly solar power on that. But that is the highest value added way that Nigerians can earn foreign exchange. So, and it's something that can happen much faster than build a manufacturing plant. I mean, if you take the Dangote refinery, Mr. Dangote, what an incredible effort to build the largest refinery, I think, in the world since the 1950s, but it's still not on stream. And we've been watching this progression over the last decade, whereas these outsourcing jobs for business processing outsourcing, for coding, for animation, we can produce in a matter of months. So that, to us, is the strategy. As I said, PwC Nigeria will be putting out a very big economic paper soon that argues for this. And we'd like to see 2 million young Nigerians in the global value chains in less than a decade.
All right, Andrew, we're going to take a break now, but when we come back, let's also focus on the rising dollar and what that means for African economies as well as the context of this debt conversation we tend to have. Now, the world economy continues to suffer from a series of destabilizing shocks, and with economic growth slowing, a rising dollar is just simply adding to the world's challenges. We'll tell you how and why African economies should be very concerned about this. Stay tuned. Roughly 40% of the almost $30 trillion in annual global trade is priced in greenbacks. That's the US dollar. And its relentless rise is risking creating a self-sustaining doom loop. Now, according to some estimates, the US dollar stands at an all-time high, up 15% against a basket of currencies since mid-2021. Still with me is Dr. Andrew Nevin, Chief Economist for PwC Nigeria. Now, Andrew, when we see rising costs of food imports, deepening poverty across the world, we've also seen the debt default in Sri Lanka, losses in financial capitals with bonds and stocks. A lot of people will wonder, a high dollar sounds like a good thing. But in terms of some of these things I've laid out now, why is a high dollar not such a good thing? Why are these things tied to the rising dollar?
Well, when the dollar rises so fast, it's highly destabilizing around the world. As you said, most of global trade is priced in dollars. The dollar's gone up; it drives up inflation in countries that imported goods, and you need to start to make adjustments for it. And particularly countries that are totally import dependent on commodity, both food commodities and energy commodities, are really at risk with the rising dollar right now. There are both the rising prices and the rising dollar, which means in their local currency terms, in effect, the prices of oil or fuel or energy and agricultural products are rising at an incredible rate on that. And we've seen some of that in Nigeria. Of course, we should have been protected because we're supposed to be an oil producer, but as I said a little bit earlier, we haven't been producing enough oil to get the benefit from it. Otherwise, we would have actually been a beneficiary of the rising dollar and the strength of the oil market on it. But overall, globally, particularly for developing nations, it's a real problem. And of course, with the rise in the interest rates, you also get the investment flows. So money comes out of emerging markets, drives up interest rates in emerging markets very rapidly because people are rotating back to the safe haven. If you want to keep money in your local bond market, for example, you have to raise interest rates more than the US has raised its interest rates.
As you talked about emerging markets and, of course, developing economies, one of the biggest concerns right now is how the rising dollar may also fuel African debt default. We've seen Ghana, Ethiopia, and Kenya being flagged as African economies at the risk of default. So let's look at that. How much risk do you think some of these African economies are carrying right now? And is there any way around this? The majority of our debt is held in US dollars.
Well, for the countries that you mentioned, I'm not sure. I mean, I think they're in a very difficult position. I mean, their debt to GDP ratios are in the 60s or 70% at least, which is, of course, much higher than Nigeria's. They're kind of flashing red when interest rates go up. The price goes up, and of course, many of them are also indebted to the Chinese as well, which creates particular difficulties because the Chinese don't have a history of being able to restructure debts in a meaningful way. So we may be headed to a situation in Africa in general where we need another, like the Club of Rome type of debt restructuring that happened in the mid 2000s. And of course, this is what typically happens when you have repressed interest rates. So if we go back a little bit of history for a moment, I mean, great financial crisis in 2008, 2009. I was in Nigeria at the time. I remember the restructuring that was led by the central bank. The governor of the Central Bank of Nigeria, of course, is His Royal Highness Mohammed Sanusi II. Did a fantastic job in this country. But globally, what happened coming out of that was that, for example, if you take the European Union, they said, we'll do whatever it takes. So what it took was keeping interest rates low for a very long time. And there's a word in economics for that. It's called financial repression. So you keep interest rates very low, in the case of Europe, negative for over a decade. What happens? Well, people build up, they borrow money because it's inexpensive to borrow money. You're not really paying the full cost because the interest charges are being artificially repressed by the central banks. So it's not a big surprise that some countries, particularly those in Africa, Kenya, for example, took on a lot of debt. And now we have, the economies have not necessarily performed as well as they thought. Because at the time they might have thought they'd grow at 5-6%, they've grown at 3-4%. So their economies aren't as big as they wanted to be. And the cost of servicing that debt is going up very rapidly. So it's a very difficult situation on that. And I've said for a long time, in fact, I did the work for PwC at a global level on the last financial crisis. And I've been saying since 2011, 2012, this cannot be right, this artificial repressing of the interest rates. And I think now when we come into 2022, combined with what's happened with COVID, plus now the Russian invasion, the culmination of that policy, the weaknesses of it, the structural weaknesses of it, the danger presented is really coming to the fore. And many African countries who have largely dollar indebtedness are going to really suffer over the next few years.
And so there's also some pressure right now on the European Central Bank to also raise its own interest rates to prop up the euro and subdue the cost of imports, also including energy, because of the Russia-Ukraine crisis. So if we were to see the ECB respond in this way and also have the US Fed continue on this hawkish stand, what would happen with the continent? Because it would seem, again, we're caught in the middle with situations outside of our control, global headwinds that are unfortunately bringing direct impact to our citizens.
Well, I mean, just go back to some fundamental economics. I mean, the most important rule in economics is that positive rates are supposed to be, interest rates are supposed to be positive, because future consumption, for all of those who remember their courses back at university, future consumption is worth less than present consumption. So we're supposed to have positive interest rates, and positive means the interest rate's higher than inflation rate. So I said we've had more than a decade of financial repression where artificially we've kept interest rates below inflation. We're now coming up to the point where, of course, that ultimately unleashed inflation. We've got 8, 9, 10% in the Eurozone. We still have the rise in the European interest rates was from minus 0.05 bank rate to 0. And yet you've got 8% inflation, which means you're still getting a extremely large negative return. So the pressure on the Europeans and Americans who've gone further in raising rates, but not nearly enough, is going to be continue to raise the rates. And of course, a little bit like a year ago, people were saying, well, inflation is transitory, supply chain problems are transitory. That's shown not to be true. And now we're getting embedded inflation. In the UK, you're having, of course, these unions demanding, rightly so, that their members get increases equal to inflation, which would mean 8, 9, 10% in the UK context, which again continues to build inflation in the system. And all of that is whipsawing Africa. I mean, Nigeria is actually in a better shape than almost everywhere else in Africa, but in Sub-Saharan Africa. But when you're in a situation where it's difficult to sell your bonds in local currency, so you're forced to borrow in US dollars, and you have such a volatile currency like the Kenyan shilling, then you're really at the mercy of these kinds of shocks. And of course, for a decade, it seemed like it was benign. Interest rates were low in US dollars. The Kenyan shilling has been relatively stable in the last decade, but all of that is unfortunately becoming unraveled. So it was like a ticking time bomb waiting to happen. And any political actor, what they tend to do is want to make sure that nothing goes bad on their watch. So the people that served in these posts, central bank posts, for example, or government ministers of finance in the period 2010 to 2018, 2019, say to the beginning of COVID, if you've served out your time and left, you kind of can claim you've left everything in good shape, but you were just building up these pressures that were eventually going to come home to roost. And of course, if you haven't made your economy structurally strong enough to withstand these shocks, you're going to suffer. So that's where Africa's at. As I said, I mean, I've given the short-term solution for Nigeria, the medium-term solution, but for Africa as a whole, the only viable path over the medium term is for Africans to trade more with Africans, to take the US dollar out of the system. I mean, one of the things that I've advocated for a long time is the cost for us to use the US dollar in African trading is absolutely immense for reasons we all understand. So I hope this is a real catalyst to start to think more about how do we use local currencies for trading. I know that Afrexim Bank and AFD, the African Development Bank, are heavily involved in trying to think this through, because I mean, it's just a burden we shouldn't be bearing. So we use the US dollar for trading between, say, Ghana and Nigeria. And then when the US dollar rises like this and the US interest rates rise like this, it destabilizes both of our economies.
And you did beat me to the punch, because my final question was going to be how we can, of course, do more to address these issues. But you've addressed that, particularly hammering on the African Continental Free Trade Area agreements and how that can help to sort of, protect us from these shocks. But Dr. Andrew Nevin, I know we see you every once in a while, but we look forward to seeing you again sometime soon. Thank you so much for joining me today.
No, thank you so much.
All right. And even though there are global economic headwinds and it's being felt across the continent, when we come back on Business Edge, we will be drilling down to Africa's most industrialized economy. That's South Africa. But that comes up after international business news. Do stick around.